To this show where we try and decode what Budget 2021, a much anticipated budget, was all about. Well, from a personal finance point of view, no new taxes, but no tax cuts either. The market is rejoicing on that very fact because there was a fear that there could be a reintroduction of, say, the wealth tax, there could be a COVID surcharge, but none of that has happened, and that's giving relief to the markets. As a taxpayer, as a salary taxpayer, as a middle-class person, well, there is no further tax benefit to what was announced last year. Nothing at all, but no new taxes either. Certain other aspects that we'll talk about with our panel of experts. Joining me is Sudhakar Sethuraman, who's the partner at Deloitte, and Surya Bhatia, who is a leading certified financial planner. Thank you, both of you, for joining me. Let me come to you first, Surya. A bit of an easy day now for you. Not much to decode as far as personal tax is concerned.
Yeah, that's right, Vivek. I think the expectations were quite tough. As you rightly said, there were concerns on the COVID tax in the form of a surcharge or a cess. You're also hearing about STT change, tweaking the capital gain because the number of demat accounts opened in the last calendar year. I think nothing of that sort. So I think status quo, which is actually is good. And I think that's why the markets are rejoicing. Tough fun from them because they're targeting a huge disinvestment. And that will be really tough fun to see. So we have to see how the execution happens for the market to sustain at these levels. But overall, I think you couldn't expect for more.
Sudhakar, pretty much a status quo budget as far as taxes are concerned. Is that also a good thing? Because somewhere I think we need to get out of the habit of expecting something to change dramatically every year. And sometimes, as Surya said, a stable regime may be a better way of going forward.
Yeah, that's right. One way to look at it is a stable regime is a better way to work, and we cannot expect dramatic every year. But some of the personal tax related expectations were there in the requirement list of the taxpayers for quite some years. And for example, last year when the government introduced the optional new tax regime, it never had that much amount of takers from the system. There were some amount of expectations on those things, but glad to note that no new taxes have been introduced by the government, and they have also given some relief to non-residents on some accrued income overseas to avoid double taxation. For senior citizens, they have exempted them from filing the return while paying the taxes is still there, and a dividend has been made. There is no direct tax on dividend. So certain things are quite a welcome move from the government.
How much of a benefit do you see in this new decision of people, senior citizens above 75 years of age, if you only have an interest income or if you're only on pension or both, you don't need to file tax returns? Is that something as a game changer from an individual relief point of view?
I think psychologically, I would say that it would be a big relief for a number of senior citizens because whomsoever has got interest income and pension income, they would be exempted and go through this hassle of updating them about what is the new form for this year, whether they should choose ITR 1 or ITR 2. They don't have to go through any of those processes. So from that point, it would be psychologically a good step forward by the government in terms of helping the senior citizens out. Because they have worked for so many years and in a way paid taxes for so many years, and they should not be burdened with additional compliance at this ripe age. So that is a right move from the government.
Surya, your thoughts on that for the senior citizens?
I think it's a good move, Vivek. It really, besides the hassle which all the senior citizens carry at their age, I think if the pension by default actually does a tax at source, and in the interest income also, if they take that form, 15H, and they can actually go ahead and make sure that the compliances are done at source, I think it's a great move.
But then if a senior citizen has invested, say, for example, in equity or in a mutual fund, then this benefit goes away because there it's more of an accrual capital gain. Then this benefit doesn't exist, is it?
That's right. It does not exist. It only is applicable when you have a pension and interest income. And I think rightfully so to an extent, because if a senior citizen is dabbling in the equity market, which is good, then he or she is smart enough to go ahead and file their respective returns.
Fair enough. Uh, from a financial planning point of view, Surya, what would you do now? I mean, we've seen a very strong rebound in the stock market. We've seen losses over the last few days, but today seems to be a good day. We can't obviously predict what the next few days will be, but do you believe that
Sure.
this was one big event and this is now behind us and we'll get back to the basics? And what could those basics as a financial planner be that when we wake up tomorrow morning that we all should be looking at?
I think that's very important. The events should be sidelined because people were waiting for this to happen. A tick on the box happened, and the good part is no major changes, no big changes in your decisions and in your planning. I think the life just goes on. You don't have to change or tweak your planning or investments or savings because of any change in capital gain or in STT or a holding period because of capital gain. So everything has been kind of status quo. So therefore, you just carry on and just put this event aside. So good for the equity markets, but Vivek, if I just add more over here, it is actually tough right now for the debt market because of the borrowings for the next 2 months at 80,000 crores and the next fiscal being pegged at 12 lakh crores. I think the GSEC yields have actually shot up and crossed 6%, so which actually is a negative for the debt markets in the short term. The key is how do they really manage the borrowings from here is something to be seen. But it's actually a negative for the debt market right now.
Can you elaborate a little on that from an asset allocation point? Therefore, what should people be doing now that we have a vision statement of 2 months? Of course, she talked about the rest of this year, but even for next year, there's a number. More importantly, she's talked about getting back to a 4.5% fiscal deficit only by 25. So there is a path there as well, a gliding path in terms of how expenditure would, and borrowings would play out over the next few years. So if you could explain what that means for a retail investor investing in debt.
So that's a good thing that they have laid down a roadmap for the next few years, which is very important. So now you can actually plan, any retail investor or an HI investor can plan the investments in such an order that as you get out of this COVID period, I think the interest rates are bound to go up in times to come. So you have to be careful about your secured investments, your debt investment, which are not fixed income securities. And if it's a fixed income security, I think in the next few quarters, you may see signs of the interest rates going up. It may not happen immediately, and by default, there's a inverse relationship between the bond yields and the interest rates. So therefore, when the rate starts rising, it will be a negative for the, let's say, a mutual fund debt market or a mark-to-market debt instrument. So therefore, you have to plan your investments in such a manner that you are able to judiciously invest in the debt investment. And now, because the path is clear in front of you, you can plan it correctly.
Sudhakar, can you tell us a little about what she's, or interpret a little more about the bit about the dividend taxation a bit? Sudhakar, you're on mute. Can you unmute yourself?
Yeah. So two things have happened with reference to dividend taxation. The first thing and a welcome thing is that she has exempted the applicability of interest for delayed payment of advance tax, which is on account of not estimating the dividend income within a particular quarter. So, for example, if I'm going to earn a dividend income in the month of January, then I will be required to pay advance tax only in the March installment, and I will not be charged with any interest for the previous 3 installments when I'm estimating my income during a tax year. The second change which she has done is they have also said that dividend distribution will not be subject to withholding tax by the payer. That again is a welcome move. So taxation will be only in the hands of the recipient. They can pay advance tax. They can pay the tax as per the tax treaty if they are a non-resident and eligible to get covered under the treaty, or they will be taxable under the provisions of the Act. So these are all the two changes which has happened with reference to dividend.
Surya, can you tell us a little about the zero coupon bonds that she seems very keen on introducing for the infrastructure side from a retail investor point of view? How do these work? Would you recommend this for people to invest in? Surya? I don't think he can hear me. Okay. So, Sudhakar, can you tell us a little about these infrastructure bonds?
Right. See, government is looking at looking at creating more funds using these infrastructure bonds. They are going to note specific infrastructure bonds, and they will these infrastructure bonds will also have a FDI dogma permitted. So as a result, it's more in a way to generate funds to the government. And definitely, when you see the fine print in the act, there will also be provisions dealing with tax withholding or a concessional rate of withholding for these bonds, though those things are not detailed in the budget speech.
Sudhakar, from what you heard overall in the budget about the entire tax reforms, we heard about the pre-filled tax return forms coming in with pretty much all the details already pre-filled. We heard the finance minister talking about steps taken which have actually led to record GST collections. We've had some other reforms as well, lots of course on the indirect tax side. But could you explain to our viewers how do you see all these measures helping in tax buoyancy? Because if you look at the overall numbers, there's a 34 lakh crore expenditure, there's 12 lakh crore of market borrowing, there's a slightly lower disinvestment target, which means there's a lot of reliance on tax buoyancy. Do you see that playing out from whatever you've heard so far in the speech?
Right. See, when the government is not looking at introducing a new tax regime, I could only see that the government is focusing more on improved compliance and the efficiency of the system so as to improve the tax collection mechanism in the country. When you see many of the amendments, for example, dividend related amendment or the senior citizen related amendment, when you see many of this, they are focused on faceless assessments. There is an increased from the government to ensure that there is an efficiency built in the system. People are not subjected to hardships on account of various undertaking various compliance processes. So as a result, in a way, I would say that I would welcome some of these technology related initiatives, including increasing the scope of pre-filled tax return by the government, and that would definitely contribute for an efficient mechanism and will bring smiles in the face of the taxpayers.
All right, Sudhakar, we leave it there. Thank you very much for joining us in this quick personal finance wrap of what Budget 2021 is all about. As I said, no new taxes, no tax cuts as well. But lots more coming up on Money9. We will analyze various aspects of this budget, what it means for the stock market, what it means for the economy over the next few hours. So stay tuned, keep watching Money9.
Thanks.